Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're doing a mailbag. It's been a little while since we took listener questions, and they have been piling into the inbox over the last few months. So I picked out 3 of them for today. And on today's episode, we're going to cover whether annuities make more sense today now that interest rates are a little higher, how to determine whether your financial plan is actually working for you, and whether we should be concerned about the stock market with the news that Michael Burry has just placed a lot of money in short positions betting against it. We cover these 3 questions in today's mailbag. I have a lot of fun answering questions. If you have questions you'd like me to address on the show, please email them to info@threeoakswealth.com. We'll compile them and circle back to them in a future episode. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. All righty, today on the podcast, we are going to do a mailbag episode. It's been quite a while, actually, since we've done one of these. Perhaps since I've been a little bit lazy about promoting the mailbag. But even though I haven't mentioned it in quite a while, questions do tend to trickle in. Our listenership on the show continues to grow steadily. And people just have questions on their mind that they're curious about. So if you're listening today and you have a question you'd like us to address on the show, we will circle that back to this periodically. I can't promise it'll be every month or every quarter, but please do send your questions in to info@threeoakswealth.com. I will compile these and try to answer them, particularly the ones that come in more than once, meaning more than one person asking the same question, as we go along. So today we're going to cover 3 different questions. One of them is about annuities. We've talked quite a bit about annuities on the show over the years. You may know already that I'm not a huge fan of them in general for retirement planning, but the question goes something like this. Interest rates are substantially higher now. I know that annuity payouts are based on the level of interest rates. Does that mean that annuities could make more sense now than they have over the previous 5 or 10 years? This is an astute and very good question. The way that I think about this is as follows. In any kind of annuity, you're forking money over to an insurance company. And in exchange for that money, the insurance company is giving you some promise of guaranteed future income. And this comes in a lot of different ways. The most basic form is called a SPIA, S-P-I-A, single premium immediate annuity. That means that you give money to the insurance company, and then in exchange, they give you a check every month for the rest of your life or the rest of you and your spouse's combined lives. You have all sorts of options and riders that you can include on there to increase with inflation or not, and so on and so forth. There are also indexed annuities. There are variable annuities where you give money to the insurance company. They put that money in some kind of investment within that annuity policy, which is tax deferred, which is kind of helpful. And then at some future date, after the balance has grown, at that point, you can annuitize it and start taking money out of the policy or have them send you a check every month. There are a lot of different forms of this. The key is when you go to that point of annuitizing the policy, meaning you go to start taking money out of the policy, the question really comes down to how much are you getting in that monthly check every single month for the rest of your life. And so the way to think about this is if you're approaching retirement, you have a need for income, right? You're working during your working years. Your income comes in to pay your expenses and taxes and hopefully have some left over to save with. and your net worth is growing every single month, every single paycheck that you get, every single year that you have maybe profits in your business that are accumulating in your bank account, right? And then after you stop working, the spigot shuts off and you have to take that pile of assets and start drawing from it every single month. So you have a choice. If you need to pull 100,000, or let's say you need to create $100,000 in retirement income every single year, you can pull from that nest egg and bear the risk of the markets. If the markets go down, the value of that nest egg goes down, but you have full control over it. Or you can take some or all of that nest egg and exchange it for a guaranteed check from an insurance company. So you can choose to annuitize or not to annuitize all your hard-earned savings. In general, when you convert your nest egg for guaranteed retirement income by annuitizing, the insurance companies are taking some risk and they take their pound of flesh in exchange for that risk because they're taking the market. You're basically transferring market risk to an insurance company. If the market crashes and the value of your retirement assets fall, then it's going to be harder for you to take out $100,000 a year to pay your expenses than if the value of those assets is growing because it's going to draw the balance down that much faster. So if an insurance company is doing it for you, well, they have the exact same risk. The reason why annuities make sense and why you might get paid more in an annuity than what a bond might pay you if you were to take your nest egg and buy a whole bunch of bonds is that annuities and insurance companies use risk pooling to their advantage. So just like your homeowners and your auto policy, there are a whole bunch of other annuity policyholders. And when you give them money in exchange for that guaranteed monthly check every month for the rest of your life, the insurance company is going to send you a check. When you die, that check is going to shut off. There are ways to set it up to where it's period certain, meaning that they'll pay you for 10 years or 20 years no matter what. If you're not around to collect those checks, then the checks will continue to go to your beneficiaries. There are a lot of options for this. But in general, the insurance company is taking a risk. And it's better for the insurance company if you give them a whole bunch of money in exchange for a check every month, and then you kick the bucket 3 months later because they get to keep the money and they only had to pay you 3 checks. It's a risk for them. If you live to be 110 years old, you gave them this money all the way back when in your retirement at age 65 or whatever, and then you lived another 45 years. They had to pay you 45 years of monthly checks. That's a risk for the insurance company. So in general, the rate that you get through one of these annuities, the amount of monthly income that you get is greater in an annuity policy than it is on a corresponding bond portfolio because they have a lot of policyholders and they can spread that mortality risk across a big pool of people. So that is one of the benefits of having an annuity, right? It's guaranteed monthly income. You get more than you would in a bond portfolio. But I would argue that most retirees should have a healthy portion of their accounts in stocks anyway, and that's going to provide some growth and generally leave you better off. Now, before I get too far off track here, the question was interest rates are higher now. If I give $100,000 to an insurance company in exchange for a monthly check for the rest of my life, I will get more money today every month than I would have 3 years ago when interest rates were lower. That's exactly true. That's exactly right, because the insurance company is taking your dollars and investing in a whole bunch of bonds and asset liability matching their expected outflows with the money in their portfolio. So because interest rates are higher, you and I as investors get a higher rate of yield on our bonds that we buy today. Insurance companies do too. And so they can afford to pay more in an annuity policy. Now, does this make annuities more attractive for people retiring today than they did a couple of years ago? I don't think the calculus changes at all because you still get a little bit more in monthly income by purchasing an annuity than you would in a bond portfolio, but your bond rates have gone up just as annuity payouts have. And so the question is, how comfortable are you giving up control of your savings, of your retirement assets to an insurance company, and how important is that guaranteed monthly income to you? And I am still of the opinion that even though rates and payouts are a little bit higher on these kinds of instruments today, most people will be better served retaining control of their assets, coming up with a retirement income plan to where they don't overspend their accounts. They have confidence that their savings will last them the rest of their life. And if you pass away early on into your retirement, you have the discretion to bequeath your savings to whomever you want, your kids, your spouse, other family, charities, whatever. So you retain full control, and I would argue can probably spend a little bit more with thoughtful retirement planning than you can just shelling everything over to the insurance company in exchange for monthly income. Even though the monthly income is guaranteed, you're giving up all control over your assets, and it simply doesn't make a whole lot of sense for most people. There are people I know who have had great success with annuities. They can work in a lot of circumstances, but I don't know that higher interest rates today make them any more attractive than they were a couple years ago, because bond yields have gone up too, and that helps. Okay, on to question number 2. This is a great one. The question is, how do I know whether my financial plan is working? I like this question for a couple of different reasons. One of them is, this is a question that I think everybody's probably asking. If you have a financial plan, how do you evaluate the progress? How do you know whether it's working or not, right? Returns, particularly last year in the market, were pretty poor. This year, things have rebounded quite a bit, yet interest rates still continue going up. How do I know if I'm doing the right thing or not? I think the answer is that financial planning is a process. It's not a one-time thing. A lot of people out there will hire maybe a professional for a one-time financial plan and then execute that financial plan on their own, or maybe a one-time kind of second opinion thing. And that's great. But whether you're doing your financial planning yourself, or you have an ongoing engagement with a professional, or you hire a professional for a limited period of time, this whole thing is a process. And the process goes something like this. You have to sit down with everybody else in your household who's a decision maker, spouse, partner, whomever. You need to talk openly about what's important to you, what you want out of your career and your life, what you really want your rich life to look like, and then work backwards between where you want to be and where you are today. Now, that's a pretty vague framework, in general framework, but that's because this process needs to be evolve, and it's an ongoing thing. If you do this once and you say, okay, well, I'd really like to make this career change. I'd like to start an ice cream cone business down the road, or maybe open a food truck or something like that. We want to send the kids to college, and I don't want to have to work until I'm 85. That's great. And so you might construct a cash flow plan that enables you to put a little bit of money aside in a 529 for the kids, maybe a little bit of money aside for retirement, and some cash available to buy that food truck and quit your job a few years down the road. And doing that might mean that you don't get to go on 3 vacations a year. Maybe you have to go camping for 2 of them to save the extra cash. I'm just kind of spitballing here. That plan works right then, right? And you can do all these kinds of analysis. You can review your insurance. You can review your taxes, and make sure that your tax strategy is congruent with those intentions and objectives. You can look at your portfolio, obviously, and your estate plan, and just make sure everything is lined up to enable you to not have to work until you're 85, quit your job, buy the food truck in 5 years, and send the kids to school. The issue is that the following day, that financial plan that you wrote on day 1 is going to be a little bit wrong, right? Your cash flow plan that you wrote initially to enable you to do all those things is going to look different as the values of your investment portfolio and the 529 accounts fluctuate, as the kids get older, maybe they get a scholarship and you don't need the money. Maybe they go to junior college for a couple of years to knock out their gen eds, which is a really popular way to get education these days. Maybe you go a few years down the road of buying that food truck, and now all of a sudden you're offered some kind of promotion or career transition, and now your job is a lot more attractive than it was. The whole point is that life evolves, right? And as you go along, you need to revisit this process of, here's what our goals were previously, but here's what I'm thinking now. This is what we prioritize. And this is how our finances need to reflect our priorities and our values and our objectives. It's an ongoing thing. It's not a one-time thing that we can just visit and then step away from, right? Same goes for retirement. By the time you hit retirement, your life is usually a little bit more solidified. If you have kids, they might be older and out of the house. There's less change when you hit your 60s than there is when you're in your 40s. Nonetheless, your priorities probably change. I don't know anybody who spends more money in their 80s than they did in their 70s, for starters. And so a lot of people who have grand ambitions to travel and do all this stuff every single year after they stop working, your day-to-day life when you're 84 is not going to be the same as it is when you're 72. And so your planning needs to evolve and at least annually come back to this exercise of identifying what's important to you, what your values are, and aligning your finances and your income and your insurance and your taxes and your investments and your estate planning to make sure that everything is lined up, pushing you closer to what those objectives are, those objectives of the day are. So the question was, how do I know if my financial plan is working? My answer to that is, you know that it's working if you're able to articulate what's important to you in your career, in your life, in your finances, and have confidence in the strategies that you are employing across your cash flow, your debt management, your investments, your tax planning, your insurance, your estate planning. If everything that has to do with your financial life, you are confident in what you have, what your strategy is, and you're confident that it supports those objectives as they are today, not as they were 2 or 3 years ago or what they might be tomorrow. That's how I think you know your financial plan is working. There is a tendency here to look at things through rose-colored glasses, and I will caveat that this feeling of confidence is of primary importance. You need to have a strategy, make sure that it's working for you. You also need some degree of confidence that strategy will lead you to the desired outcome. And that's part of the whole planning exercise too. So every year when you revisit, or maybe you do it more frequently, you revisit your intentions, your values, what you want in your career and your finances and all of the above, and you create all these underlying strategies or refine them to make sure that they support those intentions. You need some measurement, some yardstick to make sure that the strategies will support the intentions. And that's where software comes into play, and Monte Carlo analysis. We don't want to put all our eggs in the Monte Carlo analysis basket, but it is a very helpful yardstick. And we had an episode on that here a few weeks back. You might want to check out if you didn't catch it. But those are the two things that I really look at. You have to go through the process consistently. You have to have confidence that what you're doing is congruent with that. If you don't know what the strategy is because you hire an advisor for help with that, that's fine. That just means you have to have confidence in the advisor and what they're doing. And if you're doing it yourself, then you better know exactly what the underlying strategies are, because that's where you get into trouble of what's going on underneath the hood might not actually be contributing toward your long-term success. And a lot of people that we've seen over the years in the firm who like to do this stuff themselves, there's nothing wrong with that. But one observation I have is that if you're married, if you have a spouse and you're planning for things together, having an objective professional to just spit these things out to and expound on what's important to you, and someone who can lead the discussion so you and your spouse are both heard and you have an objective party that's recording all this and kind of leading that discussion to make sure that typical marital dynamics don't, interfere is really helpful. And I think it takes a really sound relationship with your spouse to be able to do that openly on your own in a successful and effective way. So that's my 2 cents on how on whether your financial plan is working and how you can tell whether it's working or not. Both spouses have to feel confident about that, by the way. It's not just you. Everybody in the household has to have that clarity and that confidence in what are we building toward and what are we doing to support that objective. Okay, this one's a little bit more technical. Third and final question for today is, Michael Burry is short the market. Should we be worried about that? Michael Burry, and for context for everyone, I watched the Big Short on Netflix again recently. And so if you have a Netflix subscription, I would encourage everybody to watch this. I've seen it probably half a dozen times, but I watched it again because it's a great movie. The movie is about the mortgage crisis and several different hedge funds and investment professionals who saw the bubbles in the housing market and bet against the housing market. They caught a lot of flack along the way. It was incredibly challenging for people to hold on to that trade at the time, but it was the right trade and they wound up being right. And so Michael Lewis is a financial author. He wrote Moneyball, which is about the Oakland A's way back when. He wrote Flash Boys, The Big Short. What are some others? I think his original one was actually Liar's Poker, about the bond markets and Louis Ranieri way back when. At any rate, he wrote this book called The Big Short about the mortgage crisis and this group of investment professionals who identified it and bet against the market and all the challenges that they faced. They made a movie out of it. It's great. Ryan Gosling's in it. What's his last name? Steve Carell, Michael from The Office is in it, and several other famous actors. Christian Bale is in it as well. At any rate, one of these characters, it's all based on, it's nonfiction, right? The movie embellishes the story a little bit. Not everything is completely factual, but for the most part it is. And Steve Carell's character is a New York hedge fund manager. The hedge fund is backed by Morgan Stanley. His real name is Michael Baum. Christian Bale's character is on the West Coast, a different hedge fund manager. He's a medical doctor who turned hedge fund manager named Michael Burry. And Michael Burry, during this time, had a fledgling hedge fund. He had a group of investors that he had done well for, who had invested in his hedge fund. And he started identifying all these problems with the housing market, with credit default, CDO, debt obligations, collateralized debt obligations, mortgage-backed securities, how banks were lending to buyers of these mortgages who had no business getting a mortgage in the first place. There were all these problems with the housing market that are now apparent. Well, these are some of the first people to identify that. And so Michael Burry took a very bold position and bet against the housing market, which was not only an unpopular opinion, it had really never been done before. Credit default swaps were the instrument he primarily used to do that. And basically what that means is it's a derivative instrument where he gave a bunch of money to various investment banks in exchange for insurance against the housing market. And so if the housing market went down in value by a lot, his hedge fund would make a lot of money. But there's collateral issues. If the housing market stayed even and level, then he doesn't make any money and he has to continue paying these premiums on the insurance. And if the housing market goes up in value, then he has to pay larger premiums. And so this is really scary for him, because he's in a position to where he's shelling money from his hedge fund into this investment that he's confident is going to pay off, but he has to keep putting more and more and more money into it until it actually comes to fruition. He's got the value of his fund going down because he keeps having to throw more money at it. His investors are barking at him. It was an incredible thing that he was able to stay in the trade and execute that successfully. There are very few people on earth who could have done that and navigated those waters at the time. Everybody's telling you you're wrong. You have so much conviction that you stick with it through thick and thin, and you're eventually right, and the market, the housing market crashes and collapses before you run out of money, basically, or get kicked out of the management of your fund by your investors. All the while, he has to keep shelling out money. All the while, the value of those securities are determined not by any free market. They're determined by the investment banks themselves who sold them to him, and were basically priced in an unfair way to Michael. So there's the context, right? The question was, Michael Burry is short the market. Should we be worried about that? If you read The Big Short and then you catch like you read The Big Short, you think, this is the smartest guy in the world. I need to invest all my money with him, and anything that he does has to be right. And alongside, so if you read the book, it's easy to come to that conclusion. And then if you catch a news headline or maybe a tweet about how he is short the market and expecting the market to go down, he has all this money positioned in a way that his fund will benefit if and when the market goes down, you might think, holy smokes, the market's about to go down. I need to be short the market too. I should at least sell my stocks. This is one of the smartest guys. He had one of the greatest trades ever on Wall Street. We need to follow suit. Not so fast. This guy made an incredible trade and has a massive amount of respect from myself and a lot of the investment community for having done that. Since then, his track record is not all that good. He made bets on water rights after the housing market that didn't go so well. He has been wrong three or four other occasions. And I say wrong, I mean that he placed trades in a way that didn't materialize the way that he thought they would, and he traded out of them before the event he was betting on occurred. And on top of that, the guy is a hedge fund manager, which is investing in a hedge fund is completely different than the investing that you and I ought to be doing as individuals. This guy is primarily investing for really wealthy people and institutions that have broad exposure to the markets in general, and this is a specific strategy within that broad exposure. So you might have a pension fund with $5 billion, and they put maybe 100 million into a hedge fund like this to make these more active bets, provide some diversification, and reduce exposure to the core markets. Right? You and I don't need to do that. It's really expensive to get into these hedge funds in the first place, and I am convinced that you'll reach a better investment outcome over the long term by just being a more passive investor and long the market through and through. So where even if the economy doesn't look so good and you have an investment hypothesis that things are about to crash, maybe based on what Michael Burry is positioning his fund with or fund as, even if that's the case, we're wrong as much as we're right with this stuff. And it's better for people saving for their own retirement just to be long through and through. If you're an institution or an endowment fund, your liabilities and your time horizon are completely different from what you and I are investing for as individuals. I mean, the average lifespan is 75 or 80 years old in the US. We're going to work for the first, until we're probably early, mid, late 60s, something like that. And then we're saving for maybe a 25 or 35 year retirement just to be on the safe side. Institutions last for hundreds and hundreds of years. Endowments, sometimes longer than that. Their liabilities aren't based on working years versus retirement. They have revenues coming in from people contributing to the fund, investment growth, and they're paying out like in a pension fund, they're paying out liabilities to retire. It's totally different. So apples and oranges, number one. Number two, the media has reported this as in a way that captures your attention and mine. And it goes something like this. Michael Burry from The Big Short bets some huge $900 million or $1 billion against the market. And technically that might be true. What that means is that his exposure through leverage is $900 million or $1 billion. His fund is almost that. I think it's maybe that exact size. He's not putting his entire fund into these instruments. He's putting a fraction of those amounts into instruments that'll pay off if and when the market crashes. But through the use of derivatives and the use of leverage, it's you put $1 into this thing, and if the market crashes, it will return $5 or $10. That's what leverage is. So he's only put a fraction of the amount that's being publicized in the media into these actual instruments. And they're simply in the business of capturing our attention so that they can sell ads and subscriptions and so forth in a way that's not really, it's not exactly what's going on there. So this is a guy that has a whole lot of respect in my mind as an investor. This is also a guy that got one trade really, he hit the nail on the head here once. He's not been quite as successful with his investment call since then, which is, guess what? That's happened just about every single time there's been a market event. There are a handful of people who call it right. The next time there's a market event, those same people call it wrong because there's just a lot of investment professionals, and some people are bound to be right if you have 10,000 people making an investment call. So I'm not concerned because of that. There's just too many reasons that the way he's positioned his fund is completely unrelated to the way that our portfolios should be positioned. And on top of that, there are a lot of other really, really smart, great investors, hedge fund managers, pension managers, all of the above, who are bullish and optimistic about what the market's going to do over the next couple of years, to where this doesn't concern me in the least. There are, there's always data that you can find in the markets to justify a concern that things might be slowing, the economy might be slowing down, or the markets might crash. It's never 100% clear. And if it is 100% clear, that would make me suspicious. This is an example of that. There are a whole lot of investment professionals out there. A lot of them are very bullish on the market. This guy just happens to capture headlines because he's short the market, and the movie that was made about him just appeared on Netflix recently. So that's my thought. Those are my thoughts on question number 3. So I think we covered it. We had 3 questions today. Do annuities make sense with higher interest rates? I don't think they're any more appealing than they were previously. How do I know if my financial plan is working? It's based on your comfort level with the strategies, your ability to articulate your objectives and your values and what you're really trying to accomplish, and some stress testing and confidence that the strategies will support those objectives. And should we be worried because Michael Burry is short the market? I'm not concerned about it. I don't think you should be either. So that's it for today. Again, if you have questions you'd like us to cover on the show, throw them in an email to info@threeoakswealth.com, and we'll compile them in a future Mailbag episode. Thanks for listening. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.